Welcome, traders. Hey, I want to build on something that we looked at recently. So here a week or two ago in the Compare and Contrast series, we compared owning long stock to selling a short put. And we kind of looked at, how those two differ a little bit. Both of them do have largely the same amount of risk as owning the long stock. Selling the short put had just a slight amount less risk because of the credit it took in. So know that what I'm going to share here today, I'm going to do a new start to finish trade, but this trade really isn't going to have a finish per se, because this particular trade is one that's called the wheel. So I'm going to walk you through how the wheel strategy works and why traders use it. Now keep in mind, I guess I should say why not necessarily traders use it, but why investors use it. This is a little bit more of a strategy that's designed for longer term investors. And let me kind of walk you through how the wheel strategy works. So basically, it's a popular option strategy, involves buying and selling options in a specific order, and you do take assignment of stock here. That is part of the goal or the objective. I know a lot of times people hear that term, get assigned, and they kind of freak out. Well, here, that's what we're looking for. We do want to get assigned stock, and at some point, we want to have that stock called away from us as well. So let me kind of walk you through how that works. So the first step here is we're going to identify our stock. What stock do we want here? Then from there, we're going to choose an expiration where we want to sell our option. In other words, how far into the future do we want to go to where we're going to sell our put in this case? So we're going to then choose the put strike price that we want to sell. And I'm going to go through all these steps here in just a moment with a trade that I'll be doing, again, in a start to finish trade. This is a paper trade. This is designed to help people understand the process. Then we're going to sell our put for a credit. That credit lowers our cost basis when we do finally get assigned. Again, you'll see that as well. And then when we do get assigned, we have to be prepared to pay for those 100 shares of stock, whatever stock it is. We have to have the money there. That's why this is actually called a cash secured put. It basically means that we know we have the money in our account to pay for those 100 shares when the time comes that they do get assigned to us or put to us. So, and then assignment means that, again, we will be buying those 100 shares, so that money has to be there. Once we get assigned the 100 shares, now we're going to start selling calls against the stock that we own, waiting for it to get called away from us at some point. And these two steps, selling the put step, we're going to sell that for a credit, and that credit will lower our cost basis in that stock. Then when we get down to this step as well, after we own the stock, then when we start selling calls, every time we sell a call against that and the stock does not get called away from us, we have lowered our cost basis in that stock. So let's go over now to option strat, and let's kind of take a look at what this looks like. So we come in here to optimize, build, and we do a cash secured put. Now, I happen to personally be bullish on Google. I own quite a bit of Google shares, and it's not really, for me, it's not really about the search engine. It happens to be about the fact that they own YouTube, and I have grandkids, and I would say 90% of what my grandkids watch is they watch YouTube. They don't watch cartoons and things like that. A lot of times they're watching educational content. A lot of times they're watching things, other gamers playing games that they like to play, etc. But the vast majority of their viewing in the younger generation that I have observed is YouTube, again, which is owned by Google. And I don't believe at this point that Google's really monetized that to the full extent that they can. They also have a fairly new product. I mean, it's been out a couple years, that is called YouTube. Shoot, I have it. It's basically YouTube. It's YouTube's version of cable, where I get all my local network channels and all that sort of stuff. I think it's YouTube TV, I think is actually what it's called. So anyhow, for those reasons, I like Google. I want to own shares of Google. Google also is, in my opinion, an interesting stock just because of the way that it trades. If we look at a chart here of Google, it has a longer term uptrend to it. Here I'm looking at daily bars because I actually want to decide right now where am I wanting to sell a put. So we'll look at that in just a second. Google does have earnings coming up here soon. That is going to be a factor in our decision. Some people may not want to do this until after earnings because sometimes earnings can move a stock pretty significantly. In my case, I'm okay with that. So I am going to proceed with my game plan here of entering a wheel strategy. So the first thing I want to do, again, is select my stock. Okay, well, I've selected it. It's Google. That's what I want to do this on. I'm going to come out to an expiration date where I want to sell a put. Now, I could, they announce earnings, I think it's on the 26th or 27th, so I could come here to July 28th and I could sell my put right there. But and if a trader wanted to be active on something like this that has weekly expirations, you could literally sell puts every single week until you get assigned, and then you could sell calls every single week until it gets called away. I don't like to be quite that active. I like to get out and about a lot, and I don't want to have to mess with this on a weekly basis personally. So I'm going to do this on a monthly basis. The monthly expiration here is the 18th. So I'm going to come into August 18th. Now I need to decide where do I want to sell my put. So Google's currently trading at 120. If we come over and look at a chart here, if when they announce earnings next week, if they announce something not so good in earnings, if earnings doesn't go well, I could see from a technical standpoint Google dropping down here to the 115 range, or maybe even all the way down here to the 110 range. It could just as easily, they could announce something good and it could pop up to 125, 127, whatever. But again, I'm looking at it from the downside risk because that's where my risk is in this particular trade. It's, again, somewhat equivalent to owning the stock. So I view downside risk as likely being around the 115 range, maybe down to the 110 range. Of course, with earnings, things can always get weird, and it could certainly get much worse than that. I mean, there have been earnings reports that some companies have put out that have caused a 15, 20% move in the underlying stock. So we always have to be aware of that and understand that's the same risk we have when we own a stock. So if you have to be prepared to act like an owner of this stock when you sell this put. So where am I going to sell my put? Well, right now, if I sell my put at 120, because of the amount of money I'm bringing in there, $4.30 or $430 for the 100 shares, my break even is all the way down here at 115.70. So if Google came down to 115, I'd still be profitable at that point. I would be getting assigned at 120 if that's where it was at expiration. But because I sold that for $4.30 a share, I still haven't lost money in that scenario. So that might be a little close. I might not want to get assigned, that quickly necessarily. So, maybe I look at 115. Maybe that's a reasonable place. And at 115, I'll be taking in approximately $2.20. So $220. And then my break even, Google would have to get all the way down here below 112 before I would start experiencing any loss in this position. So I like that a little better because, again, as I noted here, I think a pullback to 115 is probably reasonable, but it could also come all the way down here to the 110, 108 range, somewhere in there. Of course, it can always go a lot worse too, but that's kind of my projections, if you will, for downside risk on this under normal circumstances. So based on that, I'm thinking that I'm going to go ahead and I'm going to sell this 115 put. When I sell this 115 put, I have to have enough money set aside to be able to buy that stock if it gets put to me. So this is going to tie up money in my account. I have to be aware of that. I have to be okay with that. Again, I have to be okay with getting assigned this stock. This is not a short-term trading strategy. This is a long-term trading strategy designed to provide lower cost basis in my trade. That's really what we're all about here. So let me come back to this slide presentation here. So that's kind of the steps that we're going to go through. And then we want our stock to get called away after we own it. We're going to sell calls against it. We're going to wait for it to get called away. Then we're going to simply repeat that process. The goal here is to help us lower the cost basis in whatever stock it is that we're looking to get assigned. And every time you do this, as you continue to do this, these are some people that use these types of strategies in some of the stock positions that they enter. So that's kind of our goal or objective here. And just think about this a second. So if I come in here and I sell a 115 put, and let's look at our delta on there. So the delta is about 30. That's a pretty common place that most people will tend to sell puts. Some people will do this just off of delta. I like to do a combination of delta and a little bit of, again, technical analysis. And so if we look at this, well, again, a pullback into this 116, 115 area would be normal. At that point, I still don't get assigned. So if this pulls back to the 116 area, well, I'm still not getting assigned that stock. Come August 18th, if we're at 116, I get to keep my $220, and I go out now and I sell another put. And I can choose what price I want to sell it at that point. Now, there have been times I've done this where I have sold puts 3, 4, 5, 6 months in a row before I ever get assigned. So think about that a second. If I do this 5 months in a row, I've taken in almost $10 in put premium before the stock ever gets assigned to me. Then once the stock finally did get assigned to me, let's say it gets assigned to me at 115, because I've sold puts at $2 5 months in a row and basically pocketed that $10, my real cost on this when I get assigned at 115, my real cost is 105. So that's the objective here. Then once I get assigned that stock at 115, now I start selling calls at 120. And maybe you usually won't get as much money for selling those calls, but let's say I sell those calls for around $2 or $1.50, and I do that 5-6 times before the stock finally gets called away. I've lowered my cost basis yet another $10 in this process. So in a year where I am doing this on a consistent monthly basis, it is not unreasonable for me to have multiple months where I sell calls or I sell puts and I don't get the stock put to me, or I don't get it called away from me, and I get to keep all that premium. So that's our goal, that's our objective. So I'm going to go ahead here and I'm going to save this trade, and I'm going to save this as a cash secured put. I'm going to label this wheel strategy. And I'm going to drop it into our start to finish. And I will copy the link and I'll share the link in the notes below with everyone. as always, please like, subscribe. If you find this stuff of value, that's what helps us know what types of things people are interested in. So please do that. Please feel free to make any comments, questions, etc. I try to get to all of those. So that's it on our new trade. That's going to be a start to finish. But again, this is going to be kind of an ongoing thing. And this is designed, of course, as a paper trade for people to follow along and see how this progresses. That's it for now. Thanks, everyone.